Welcome to Jay's Corner. It is May 12th, 2024, 11 a.m. Eastern Time. Happy Mother's Day, everybody. To all of you who fit the bill, who fit the function, then it's certainly, hopefully, you're having a great day. So it's the weekend update, and I called it Savers Win. We'll get into that in just a few moments. I thought to mention a couple of things first. Of course, as always, be sure to like and subscribe. Does help the channel out, and I'm in desperate need of the channel. As I said, Jay's Corner is really about the function. Doesn't really fit very well inside the YouTube algorithm, which is set intentionally to put you into niches and then to keep you in the niches. They want you to watch for 5 hours in a row streaming. That's why they keep showing you related type videos. The issue here is that all of these topics interact. And when they interact, you have issues because sometimes what you want to occur conflict. Or in addition to that, the crossover, there's a lot of money, which is your money, which you may have saved, or the flip side, the 6 of one, half dozen of the other, to say that you've overspent. And controlling expenses, very, very important. We'll get to that in a few moments when we talk about the market as a whole and what I see. So before we get into any of that, the first stop here is over here, which is that, as many people may know here, I very, very frequently appear on thestreet.com's Retirement Daily. And Bob Powell, who has been an OG of Maximize Your Medicare, absolutely. Thank you to him, as always, for many, many years, is that I have answered this kind of question here. And as I'm reshaping it, you see it here, which is the FEHB stands for Federal Employee Health Benefits. It is the largest group plan in the country. Now, it is comprehensive, no question about that. It can and should be thought of as your total compensation, right? This is not a trivial number. Many people know that. If you do not qualify for the advanced premium tax credit, which you do not if you are offered health insurance from your employer, then many people have been on FEHB for decades. The issue is that when you change to Medicare eligibility, now the rules slightly change and you need to be aware, right? So in here, we're not going to review it today. OPM, which is the Office of Personnel Management, which is the federal agency dealing with FEHB annuitants or federal employee annuitants, that's their formal term, is the idea that you can stay on FEHB forever. The issue is that FEHB does not qualify you to delay enrollment in Part B at all. And in that, what ends up happening is people end up taking FEHB alone without enrolling in Part B, decide later that they want to enroll in Part B, and then you get into problems because they find out after the fact that then the late enrollment penalty for Part B then exists. And this is a real issue because now, for example, those persons cannot access Medigap, right? Which is that you cannot have FEHB and Medigap at the same time. In order to do so, you need to completely cancel your FEHB. And when you do so, you cannot return. And that is the issue. And so now FEHB does become more complicated than other group plans because you can do something called suspend, which is different and distinct from cancel. And now we've got all sorts of spaghetti, goulash or chop suey running around Because what ends up happening is if it's not clearly communicated to you, you make a decision, years pass, and then you find out, oh, I wasn't told exactly accurately. I didn't ask the set of follow-up questions required. Maybe I didn't know that those follow-up questions should have even been asked. Well, crazy people write books about this topic as well as appear in the national media. And here it is right here, which is that the Mammoth program, the single largest employer, and useful activities. You need to see that, in the complication regarding Part B, as well as your ability to switch. And here's your issue, which is that, as I said, you must cancel FEHB in order to get onto Medigap. Now, why would you do that? Well, there are a number of reasons. Possible, right? Which is that FEHB does have Medicare Advantage. It has Medicare Advantage as an option, viable option. Now, I'm not concerned necessarily about the network there, meaning that it is as good as it's going to get, in air quotes, right? Because as you would imagine, just put yourself in the shoes of the seller. The seller here is motivated to be aligned with the largest employer in the country, which also happens to be associated with the agency which is approving its plans. Just use your common sense. The network's likely to be good. That said, still Medicare Advantage. And this is what you can never break away from, which is high quality, even highest quality of Medicare Advantage is still a networked plan. It still has the characteristics that I've described, which is annual contract, understand the network first. If I had to break down Medicare Advantage, that is it, right? Which is you need to understand that this is annual contract. And that means every detail subject to change every year. And now you can understand why that you've got concerns over Medicare Advantage carriers. Because what you have is that the per diem, the allowance, if you will, is that what you have is the allowance is being put under pressure. And you can see this little clip here, and I apologize for the screenshot that we've got going on, right? But which is that you can see that the biggest carriers are having challenges, and we're not going to get away from that easily, right? You're talking about 50% of the population into Medicare Advantage. You're talking about pressure to push down overall healthcare cost. You got lower pay to physicians under original Medicare. In other words, everyone being pinched, including myself. Part D, many plans don't compensate me a penny, something that creates a problem, unfortunately, for the consumer in my instance, because why? You can understand my discomfort of being paid. I'm happy to work for very little if the consumer gets the right accurate answer and understands it. I'm happy to provide that guidance. That said, in exchange for it, I have regulatory oversight, meaning that I have to answer to the regulators on multiple levels as well as to the carriers. And now for that balance to be where I'm being paid 0 pennies, now you can understand the challenge that I have. It's not a pity party. It's just simple fact, that an illustration of the fact that all parties are being pinched here, and there's not really a fix it, where we can fix it in one fell swoop. Back to FEHB, that the nuances in handling FEHB compared to other employers, there can be Medicare, and this is exactly what I said, which is Medicare Advantage. Part of it to FEHB, you're an annuitant and non-Medicare, so you want to stay on FEHB. Now, this is possible, right? Because, for example, let's say you're the annuitant and you have a spouse, and you want that spouse to have access to health insurance under the FEHB. That is entirely possible. Now, the issue right, is whether or not that is the efficient choice. That, of course, is what keeps the lights on here. To examine the different price points, possible access to the Affordable Care Act's APTC, and then also whether or not that makes sense for the family as a whole. And that will vary wildly based on where you live and what FEHB charges. And so you can't just say that if you lived in San Diego, that it would be the same conclusion as if you lived in Indianapolis. That is simply not the case. And the reason is price. Of course it's price. This is a central issue, a central idea here, right? Meaning that the channel here is about clarity, actual clarity, right? I spent a lot of time trying to make it clear in many different forums. Shout out to Ali. We'll discuss them in a little bit, hopefully, if time permits. But, I've spoken to many different types of groups to try to make it clear. Nowhere am I saying two things. Number one, price doesn't matter. No, Jay does not say that. And number two is Jay does not ever say you can just simply do it yourself, right? Those are the two. Right? I stop before making those statements. You can presume that that's intentional. Maybe you're not going to call me. I'm going to have to, take a number, right? The audience is far bigger. The utility of the information I'm giving to you is far greater. I'm convinced of that. Otherwise, I wouldn't, spend my time on a weekend morning just, where I'll get like so few views, except for the people who value accurate information. So now we're back to FEHB and how complex it is, and due to what I've already explained here is disassociation. Now, this is not necessarily, yes, meaning that what you have is you would have to cancel. Careful of the associated complexities, notably family coverage and cost differences in private market options. So now you can understand why I very much appreciate Bob Powell and his group there, because I'm very confident that they're not going to pull my statements out of context. Very, very tough, right? Which is that sometimes I appear on interviews and then, there's like this little snippet and then somebody misquotes it. Or they try to say, you said X when I didn't say X, I said Y. And now all of a sudden, there's some misunderstanding, which is possible. That doesn't usually happen on thestreet.com. We usually have this conversation to make sure that this is the case. And you can see here that, yes, I didn't say that you would need to dig, meaning that you would have a lot of information given by the OPM to federal employee annuitants. You do need to be careful is your bottom line. You do need to be careful because this little nuances about the terminology used as I first started this segment, which is there's a big difference between the canceling and suspending. Those two are two different actions. For me, I've read through the OPM documentation. That isn't made as clear to me as I would like. And whether or not, right, since I'm not part of the OPM, since I'm not part of the federal government, I'm not there. No one's asking me, right? I'm just a guy. So that's what I would have to say here. We did not, they did not put the video here, which is totally fine. Bob and I record the video and then they have to be rehashed or not based on, the quality. But that is kind of where I wanted us to start here because we'll have this on an ongoing basis. The reason I'm bringing it up today, okay, and the reason I'm mentioning it with this here, and I realize again it's cut off, is that the FEHB has had or has national PPOs where they're also providing money back, called give back, into Social Security, possibly. The issue with that is that that is part of the annual contract. Meaning, I said at the beginning, when you want to understand Medicare Advantage, you want to understand network, you understand annual contract. And the first one is usually annual contract. And that means that every moving piece can move every single year, period. That is the inherent nature of Medicare Advantage. So that means copay, deductible, out-of-pocket maximum, whether or not there's dental and vision, what the maximum benefit amount is, what the eyeglass allowance is, what the dental, the maximum benefit amount is. I think I just already said that, meaning that every little detail is under scrutiny all the time. We're never getting away from that. So that means if you're a person that values stability above everything, then the moving parts in Medicare Advantage may or may not be best for you, right? Unless money matters, which it always does. So you can see what my point is, which is I didn't say at every price for every situation. Again, if you're an old man, Mr. Perfect, live in a shoe, have 500 children, you need every dollar for food. I'm entirely on board with that. Even that might suggest that Medicare Advantage be superior. That said, well, now you also live in a location where you're not Mr. Perfect, but you're in fact Mr. Sick-a-Lot. And in addition to that, you live in a geographical location where networks are incredibly fragmented, making it almost impossible to navigate, in which case, now all of a sudden, it becomes much more complicated to choose between Medicare Advantage and Medigap. That is the nature of what is going on here, and that is where we are going. That's how I'm going to conclude the Medicare portion. Okay, so now we're going to go here, markets update, there it is, and how I would state it here is relative calm. So you can see what I had said. For example, if we take a look here, what we will see is you'll see that if I take a look at what I said 2 weeks ago, what did I say here? And now we can see, this is the good thing about the internet, right? You've got a date and time stamp talking about stuff. And here it is here. And you can see the actual title of the video is Did Friday Fix Everything? And I was talking about the fact that the NVIDIAs and Google and Metas, they had reported earnings, which has gotten all the news, of course. That is always because it's easy to understand. I get all that. But the reality is that if the inside of the video, what you saw was my comments about this here, and we're going to bring it up here. Let's just see if we can take this and turn this off just for the moment. Let's see what are we doing here? Nope. So what I'm gonna do here is I'm gonna turn on the vacuum bowl. There it is. Okay, so this was in my email the other day. So themarketeer.com is a newsletter. It is aimed at the serious, okay? But you'll see that I've actually already provided a lot of the information from it, except for I did so a couple of weeks ago, which is quiet and calm Goldilocks. And the email goes and says, absolutely no yelling. And what this means is, it's a play on words, which is, Janet Yellen, of course, meaning that what you had is very light volume, and you can see who they're asking. They're asking people from the actual playing field. Here it is here. Goldman Sachs Trading Desk reports healthy liquidity. et cetera, and combinations of different types of parties, which have nothing to do with, mutual stock picker said that NVIDIA to 1200. So we see here no vol. And the volatility view, the world is all right. And now you can see it here. I'm going to just pull up this. So this looks like, I don't know, earthquake seismograph, if you will. But what you see over on your right-hand side is that the blues, all these different shades of blues, is declining. Except for the orange. We will talk about the orange here. To followers here at Jay's Corner, this should be really no surprise, because what I've just done here is the following, which is all I've done. Literally what I've just brought to your attention more than anything else is this lattice diagram. So two things. Number one, it's to correct the bias, right? That markets are looking to the future. We are here now. It's a phrase that I use with clients very many times to give them comfort that I'm not Monday morning quarterback. We are here now. Okay. Same thing for markets. They don't care. Mr. Market does not care that you hit a home run yesterday or that you made every mistake in the world yesterday. It's looking forward. And what it's doing here is it's giving you a state of this picture here is telling you what? It is telling you that this blue curve to the right here is now much narrower. In other words, the number of outcomes has declined. It doesn't necessarily make any statement about what the value of the average actually is. What it is stating, though, is that it's declining. And that is important. Why? Not surprisingly here. So now you can see why I have these still up, right? Which is this formula here tells you, and you don't have to be a mathematician. Absolutely not. All you need to see is the fact that denominator lower and more stable, both. When I said 2 weeks ago, on the video, right? 2 weeks ago on the video, what did I say? I said that, look, it is not only that interest rates had declined from 4.6, but in the 10-year note futures. But in addition to that, the Fed chairman said, look, we're not thinking about raising rates. So what it did is it not only pushed down but it also made the rest of the world less volatile. And now you can see here that, in fact, there it is in a picture. And it is interesting to me that it's not surprising to me that they're pointing this out. It's interesting to me that you see this very bright green, which is FX. You can remember what I've been saying. It's not only the denominator, right? Which many people, I've said that the US 10-year note, the most important single statistic. I'll stick with that. That part I'm not changing. But part of that explanation is the fact that this is a global R, and that has everything to do with foreign exchange. And so now what you have is non-US dollar versus euro not really moving around. And from there, you can get your path then to a lower denominator, right? Which has meant what? Higher NPVs. Higher NPVs means risky assets, higher in price. And that's exactly what you got. That's not a surprise. None of this, right? In other words, if I wrote this list down and I had no evidence of what the market actually did. But this is what the information, a list of information over the, starting with the Fed, right? Starting with Jay Powell's press conference and the latest decision by the Federal Reserve. Yes, I would have said, it very, very predictable, which have nothing to do with the fact that Google outperformed wildly compared to expectation. That is not what the input was to me. The input was, in fact, first principles. What a shock, right? That we not get distracted. And the reason is that the error, and I'm going to go back over here and I'm going to make this last point here. It's actually not a last point, but what my final point here is 2 weeks ago, I talked about the fact that Google outperformed and Meta massively underperformed. People are pleasantly surprised when, a company outperforms whatever estimate existed. To me, I'm not happy. And the reason is that I would have rather them be correct, right, and accurate, so that this amount of up and down compared to the average expected earnings reports, etc., was correct. Because then it would have implied you would have had a different allocation across the different, holdings in a mutual fund, or et cetera, et cetera. So it's pretty funny that, when mistakes get made on the minus, it's like, oh, that's terrible. And then when mistakes get made on because the earnings estimates are too low, it's like, oh, hooray. For me, I would have said, how about less error in either direction? But that is not what actually happens. And it's really to talk about the fact that, crapshoots too is wrong. We are talking about the educated people who have educated reasons for making these earnings estimates. I'm not disputing that. Instead, what I'm saying is the error rate is so high, then there's you subjecting to the crossfire, because that can go in either direction. And so now to people who own Meta at 500, well, you've recovered a lot, but it wasn't very pleasant when you went down to 410. So there you go. So anyway, I wanted to point out, it's not only me who is pointing this stuff out, right? That's just not possible. Right? I'm just reporting to you because I understand how that the playing field actually works. And now we can see it here, right? Shifting macro backdrop. So this, of course, then becomes precisely what I said a couple of weeks ago, right? Which is lower vol. And with lower vol, you could have a more supportive outcome. No surprise. Not because I knew that Google was going to outperform. That was not it. And now you can see here that the market, this is a measure of the volatility index, meaning this is equity volatility VIX. That's what it's called. Complicated stuff, no question about it. To, the nerds out there. This is basically VIX for people who do not know, right? VIX is the answer, right? It's if you already know what the market prices are, can you then solve for volatility, which is important, as you can see here. You can see in this second bracket, you can see sigma squared. There's your volatility, standard deviation of return, right? Volatility. There it is. As it goes lower, right, then what ends up happening is, yes, risky markets higher. Simple. Simple if you understand the basic principles first. And now you have Goldilocks. So if you have inflation lower, right, if you have inflation lower, you can see it here, that if you have inflation lower, then yes, possible are lower. Possible are lower. And from there, that's your setup that explains very much so what has been going on, pretty much since April, right? 6 weeks now. We've kind of come full circle in that sense. And now you possible lowered decline in the denominator. Possible lower denominator. And now, as I said, and now you can fully understand that the market sees this, and what do? They jumpstart by buying the risky assets, and that's exactly what you have. And then the feedback loop being, okay, because interest rates are lower, Jay's Rib Shack can now cost of borrowing to the small companies lower. As a result, earnings of Jay's Rib Shack most specifically higher. We are going to get to Jay's Rib Shack in a few moments. So now you can see the way that these things are connected, hopefully. Right? You will see here that my protest, if you will, my protest here on the way that you are given information generally is in fact that, excuse me, what you have is really that your given narrative that you can cling on to and understand, and I understand all of that. But instead, I would have had you understand these topics first. If you had presumed, it has just simply been, we have had an era of decades, where global central banks, in a coordinated way, have pushed R down systematically around the world. Financial crisis in Europe, mortgage interest rates were negative in many locations. Negative. Mortgage rates. That used to exist. That era is over. And that becomes an issue longer term. But of course, we live in a short-term world, right, where everyone is trying to get the dollar today. Focus on, and that also means, by focus on today, get the dollar today, that also means your viewership. Okay. That does make it it doesn't make it disingenuous. It doesn't make it wrong, factually wrong of what they're reporting. It is the question about whether or not that is the most vital. That then becomes, that's a different question. Let's go back here for just a moment because we've got some other things that I wanted to point out along the lines of what I just said, which is the way this affects people, right? Because I have stated about the interest rates and interest rates lower. That doesn't give interest rates by themselves and borrowing, right? And so here's your summary of where we've been, right? There's your market observations, right? Denominator lower and quiet. And the reality is that this is what I put here this morning. This is all unchanged from 2 weeks ago. And the reason is, this is unchanged because of the fact that these are all simply true, but this is the dominant first. Like I said, order of operations in markets matters, right? It has happened to be that this was not a big factor, and therefore you could then focus in on here. I don't think that is possible any longer, which is something you're going to have to get used to. And we're going to talk about some of that here, because this then became the last point. When it comes to planning in your personal life, this article made me freak out a little, which is Americans are racking up phantom debt that Wall Street can't track. Now, this is worrisome. So you can understand every time you try to shop online, you'll see something that says Affirm, right? Affirm Holdings, right? And very popular. This is one of those, it's kind of like the old Christmas club or layaway plan, right? That you would buy something, purchase it today, and pay in, X installments over time. The reality is that I always blew it off. I didn't have a need. And the reality is that since I don't have a need, I didn't really focus on how big it might be. Bloomberg, this article is just from this past week, right? Yeah, May 7th. So you can see here that buy now, pay later plan from split purchase into smaller installments. Pay in 4, Affirm, Klarna, Block, Afterpay. And here is the issue. They don't report these loans to credit agencies. This is the problem. And because of the fact that your personal credit doesn't get affected when you use one of these buy now, pay later platforms. For those of you who are struggling financially, right? This is like awesome, right? Because why? Because if you didn't know, for example, you click on the you're pre-approved, et cetera, for a credit card, guess what? That goes on your credit rating agency, right? I mean, if you try to borrow money to take out a mortgage, just the very fact that you're clicking around making that inquiry has a negative impact on your credit rating. This is the case. Yet, when we do this buy now, pay later stuff, it doesn't report it to the credit rating, to credit agencies to affect your personal credit. So depending on your situation, sure. Let's say, for example, you get denied by credit card and your credit card balances are too high, etc. Well, this is a way to get the purchases of something that you think that you want or believe that you need and not affect the credit agency. That's fine. The issue is the cascading of not being able to pay. And you can see it here. Consumer spending in the world's not so resilient. In the face of stubbornly high inflation, that economists repeat rip up the forecast for slowing growth in interest rate cuts. And now you can see here cracks are starting to form. I don't want to say that we are going to have financial crisis. I'm not in that camp necessarily. What I am going to say, though, is talking about how everyday people are affected. And it's not only everyday people. Let me just see here. Can I get there? Let's first go to Mr. X, right? And it is not borrowing that. Well, let's just go to Savers Win. So what you have here is, buy now, pay. Right, so this not reported to rating agencies. And the other thing here is, if you need the money, high interest rate. What you don't have on this channel, what you will not hear from me is borrowing in and of itself is not necessarily negative. Borrowing in and of itself, let me just say that again, borrowing in and of itself is not necessarily negative. And I apparently have messed this up, meaning that Mr. X doesn't appear. Let's just see. I will get there. That should do it. Yes. Right? It is not borrowing that matters, right? It is. So for example, on mortgage debt, right, there are two things, right? The rate was 3%. And then also depending on, you've got the interest rate or interest cost deduction. So if you itemize, you get so now you can see here, it is not mortgage debt depending on the rate. Right? Because now credit card debt is here. And this is literally from a, pre-approved, you're pre-approved for, it's at credit card X. Right? So you can see it is not borrowing in and of itself. It's borrowing at the wrong rate, which is the issue. Because the question that you can ask to yourself, so is it vital? Right? By no means does any of what I say apply to you if you are struggling to buy food. That is different, right? If you're struggling to pay your bills, monthly bills, right? In other words, I didn't say if you feel like you are in an emergency situation that you shouldn't pull out all the stops. That is different. That is entirely different. But absent that, then the thing is, can you make more than 15% a year? And then I'm going to ask you, are you being realistic? Right? In other words, the money that you borrow has to exceed this number for additional credit card debt. The issue here is that it can beat, right, your mortgage debt. And this is why you have the idea that don't prepay. You'll have this idea that while it may feel attractive to prepay your mortgage, the math of money here tells you that gives you a very clear implication about the order in which you should do so. So you can see it here. Since it's the one eroding your net worth faster, this is the one to pay off first. Now you can understand the issue here is the buy now, pay later. This entirety here is skewing. It is changing and making it more complicated and now you can understand why people are befuddled here about how, consumer spending is continuing on. That it's kind of strange to me. It's a little worrisome to me that, first of all, that the economy may not be as great as you may put, because things like this are allowing it to be completely rational to go and make purchases using this schematic. And now what you have is the United States is, American consumers are not only at record credit card balances, but in addition to that, there's this other form of phantom debt. Don't get me wrong, American consumers are not the only ones with this kind of stuff, right? You'll see it here, that dangerous, and you'll see it here, that things like this. You'll see Bank of International something that I've called shadow banking, and you'll see that I have talked about this, often in the past about the banking crisis when I talked about Silicon Valley, for example, and I talk about what I thought really could go, and when I discussed foreign exchange. That the debt that people cannot see, right, is dangerous. And Let's just see if I can pull up the article. Yes, here it is. Right, this is the one that I've quoted here on this channel. Here, there it is. The issue is not that it's huge. The issue is missing and growing. Right, and now you can see that in fact that's the same thing here as Bloomberg, which is that you've got this Bloomberg and there it is, phantom debt, and there it is, right? It is not surprising to me that you've got here spooks economists on the consumers also exists here around the planet. This is the fly in the ointment. I don't think there's any question about that this is the fly in the ointment. And so you can also understand that when I'm talking about stocks for show, bonds for dough, now you can certainly understand it, right? That I'm focused here to make sure that we are very well informed about the denominator. Because R here is the cost of the debt. R is the cost of the debt. And without an understanding of it, first, you are very far, you've just thought through matters in incorrect order, which is fine if R goes down and is low volatility and stays that way. Then yes. Then NPV is higher. That's what you have today. It also creates the barrier for tomorrow. Okay. It has to do, and don't get me wrong, more specifically, let's just go right here to the Bloomberg right here at the front. And now you can see that, where is it? They changed the front page here. So, for example, you can see here, nope, this is not going to be, it says, no. So what, they changed the headline. They changed the headline actually. And which is that, that small caps, not surprisingly, right? Jay's Rib Shack, right, is the most affected. This is a different Jay's Rib Shack. So it was just a different example about the shenanigans, not the shenanigans, but the way, here we go. So you can see it here, right? The borrowed at low, here's what I'm talking about. Right. So I've discussed about what happens at Jay's Rib Shack, which is basically my name for a non-specific small cap company, right? Which is if they're able to borrow lower rates, then this would definitely help who? Jay's Rib Shack. Now, small caps have not done well relative to the market as a whole. Possible. I didn't say this is the scenario here. This is the way that the theory would go. And let's see if I can bring this to the front. Yes, I can. Right, which is that the ones that would benefit the most, for example, similarly to the way that the person would benefit the most from lower credit card is because lower credit card, because the cost of borrowing would be lower. Okay. Last point here, which is that I want to point out about the fact that we're using this different terminology. Like I've used this different terminology about function, right? When I talked about debt, for example, I talked about debt and the fact that It's not debt itself, it's the cost of the debt, which is damaging. It's the cost of the debt which is damaging. And in the same way, we've got this kind of like slight nuance in wording about different stuff. A couple of weeks ago, when I made that same video, what I talked about was this particular targeted date fund, which is for newcomers. In your 401k, the default position is kind of a overall portfolio, a mix between bonds and stocks, depending on when you are going to turn 60 to 65 or retire. That's kind of the way they're constructed. This one here tells you about the fact that this article, which I reviewed, which is how BlackRock has actually created an extra bucket. That bucket would then do this, which is to kind of solve the issue that we have with this three-legged stool, which is the traditional, you can see it here. This is what retirement was, but now in the future, what we have Social Security, and that this B is now gone. And now the question is that whether or not people are educated, informed, and then will take the time to then create then B and C, right, from point C alone, right? C has persisted. The issue is the defined benefit income, guaranteed income, right, which defined benefit, the function provided by defined benefit, the function, which is layer of repeated income. And now you can understand why I'm sitting here, right? And so now what you have on this article, and this is a copy of the press conference that it was a press conference, it was a forum, but you can see it here, and I want to play this part here and the real point is about the wording.
The other shift in messaging that I think is so key is this shift from what we say, and it's a mouthful, accumulation to decumulation, right? As a financial journalist for decades, the message was just save, 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 invest, 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 and then people get to retirement whenever that hits, and they don't understand how to take this DC plan and turn it into something else. As you all think about clear language, transparency, how do you think we get that message across? Caroline.
Yeah, well, I'll start with.
So, this is very well. First of all, I'm going to give you this link here to this page because the video is actually unlisted on YouTube, which actually I'm not sure. I haven't talked to them about why it's under that status, but there are tons of quotes in the media about this particular forum. I want to say it's well over a couple of hundred at this point. The people here are, those are the heads of carriers and the divisions or departments that are entirely responsible. You'll see their names. But for example, Jean, who's one of the education fellows along of which I am one, this is a very well stated question. She's a professional. I mean, she's guru, icon of, kind of this questioning expert panelist in ways that everyday people can understand. Excellent question. So let's just see here what the first response is, and I'll cut it.
We've spoken about annuities, but we've also used the words retirement income. And I think sometimes you throw out the word annuities, and people just take a step back and say, what is it? That sounds scary, or that sounds complex. One of the things we've tried to do is talk in a language that you say, do you want to protect your income for the rest of your life? And people say, sure, I want to do that. Of course I want to do that. And if you actually ask them a series of questions that describe really everything an annuity does, they answer in the affirmative. Of course I want that. If you then follow and say, do I want an annuity? Sometimes people say, oh no, I don't want that. I want everything else you just described.
So let me just say, as someone trying to help people understand the Affordable Care Act, I can relate. Right? Which is, oh, well, I love the Affordable Care Act and the lower premium and the lower out-of-pocket maximum and the lower deductibles that are possible if I use a particular plan. But, oh, I hate Obamacare. And this is the precise analogy. It's not kind of, sort of. It's exactly the same thing, which is that Miss Feeney here, you can see, I'm not sure if you can see in your screen, right? CEO, U.S. Business Prudential Financial. Okay, right? In other words, this is the exceptionally high qualified, right? And her point here is exactly the point here on Jay's Corner, which is that I'm focused here on your understanding of what the function fulfilled is. From there, we've got jargon, which is largely to satisfy regulator and to make sure that the contracts are written clearly enough, and also so that the sellers and buyers are agreeing on the terms, right? Which also means that the sellers are not violating those terms. They're not. These are the central messages that I always try to repeat, whether or not this is your first time here or your 100th, which is the sellers are fighting so fiercely the idea that they are going to be intentionally violating the written legal contract is effectively zero. That means all your war stories, horror stories, 60 minutes, this, etc., that, is usually not correct. That includes then also health, any financial contract, any legal contract, that also means health insurance, right? Which is, it's usually not, very usually, by usually I mean 99.99% plus, usually not that the carrier is not fulfilling its end of the contract based on some set of circumstances. No. Let's just continue here. We've got some more to go.
So I think we really do need to talk about what the solutions that we create actually do for you. And I
I'd forgotten that sentence. I should have stopped it right before. But you can understand my point.
we try so hard to focus on what are the things that keep our customers up at night. And it's all of the things we're discussing. I'm so afraid I'm going to run out of money. I'm so afraid that all the dreams I've ever had for my retirement will never come to fruition because I'm going to run out of money. And so if we can take some of those things that keep people up at night and connect them to the solutions that we have readily available to solve those issues and give people peace of mind, I mean, then we're really making a difference.
Okay, and right, again, to newcomers here, you can now understand what I'm trying to do, what I'm trying to actually accomplish, right? Which is what this channel is about, what Jay's Corner is about, is like, look, let's focus on function of the money, what we are trying to do. How do we do that? We get organized so we know what the facts are. All of these different sources. And then to try to cover what? Your cash expenses. Of course we are. My point here. And from there, then we find the product, then we find the contract, the technique, whatever mechanism, financial, of which, there's like 10,000 channels each per one of these line items here. How to make more money using the gig economy. Mistakes people make about Social Security, spousal benefits, what to do about your which lump sum or pension, et cetera, et cetera. There's like 6 gazillion videos per line item here. Not by me, thank goodness. You don't want to see me 6 gazillion times, but you can understand my point. But that is then the manifestation, in other words, the execution. The point here is let's make sure that we've got this right first. Then we can fit the product to the spot. That's my story. I'll stick with it. Let's just continue.
I think it's all of that, very well said, and then it's personalizing it again, right? Bringing it back to being individualistic for each person. And I think if you take the retirement income story versus annuity or other language, right, make it about them. So if I'm sitting down with my financial advisor and I'm discussing what my retirement wants to, I want my retirement to look like, the first thing I have to understand is, well, what is it going to cost? And then how do I actually pay for that?
Okay. And now you can understand my order of as I've said here, just like when I was describing the way that financial markets work, right? You can see here, there is a focus on the order of operations. All right, what does the thing cost? Not surprisingly, right? Tell me what this is. Tell me what your expenses look like. My point here is that what ends up happening, and my punchline is going to be the following. It's going to be the last point I make today. But it's the important point, right? Is that what we have is kind of like this idea about retirement crisis. You can see this language used everywhere. And those are for clicks. I get it, right? We live in a click economy. Read me, this will get clicks, SEO, that, the other. And I understand all of that. That makes total sense. That said, the knowledge crisis here, because of these different topics that we've talked about here on this channel, it creates lack of knowledge has created fear. For me, healthcare cost plan, and now you can understand my point. That I'm trying to reduce the fear, right, on healthcare cost planning. What we also, and now you can see it here, that protectedincome.org, where I'm a education fellow, right, is to reduce the fear of that's what it's there to educate about the function of annuities as creating that particular output and function. Why? In order to try to help you understand this, because this now is gone. And so as a result, you can understand my point. This location here is to try to help you understand how this then gets solved. Okay? And so you can see what has happened, which is since defined benefit doesn't exist de facto unless you work for government agency, and a vast minority of non-government companies, that it has tasked you with taking this point C here and fulfilling this role plus this role. And we don't have time today, but actually in here, one of the people, and I believe it was Miss Feeney, she said that, at the introduction, at the earlier part of this video, to say, like, kind of glossing over the fact that where people are using stock market returns here, to determine kind of this stuff, which to me, I'm like, okay, well, some of that cannot be avoided, but some of it can. And because of that, this lack of knowledge creating this fear. So the result then of, and you can see it here, long-term care. And maybe you can call that a subsection then of healthcare cost planning. Long-term care being here, right? And when you have these three layers of fear, the inevitable result. So now you get to me where, okay, kind of like the worst, the conclusion I really, really, really don't want to see, right? Which is the idea that, okay, well, I stayed at home. I didn't go to my vacation. I didn't go on this cruise, whatever it would be. Let's see if I can do something better than this as far as readability goes. That what ends up happening is, right, I'm not the person here that our financial planning clients, right, sit on their hands. No. Why? Because we are trying to reduce the fear of these items so that you can understand the scope and scale of what these entail. But the point is that if you reduce this fear, then you can avoid this result. I didn't say entirely, right? Meaning that, yes, you could suffer a particular medical event and now all of a sudden you cannot take care of yourself. I'm sure you've heard or know someone who fits that description. Nevertheless, the point here is that what you have, and you're going to see these types of things, is that the people involved in, for example, in the Alliance of Lifetime Income, what you have here is then you're going to see this thing of something called license to spend. Right? In other words, that this license to spend, is to here, which is since you don't know, since people have this lack of knowledge, what I would call knowledge crisis, that what you end up having, and here are some things that people know very little about. So yeah, then a reasonable person, since they don't know, then this becomes the result, sure. And so now the reality is that we see lots of articles right now to say, okay, why people don't spend during retirement, why people don't spend in retiring. To me, this just makes common sense. This would be the natural result of the knowledge crisis about the fact that this three-legged stool doesn't work because this second section here is no longer the case. So now, of course, this becomes the case. This would be the, common sense result. Instead, we're focused here on this channel to try to reduce the fear, to get you to get the license to spend. And now you can understand why when I to our clients here for the for comprehensive financial planning, that basically ultimately is to get to the function of money, which is to give you the license to spend. That's it for today. Be sure to subscribe to Jay's Corner. The Substack, so important. I can't even tell you, this is, I'm trying to not overwhelm you, but give you tidbits that you can digest in a reasonable way. For that, jo.substack.com. The URL is there under my talking head, which concludes here for today. Thanks, everybody. Have a great rest of your weekend.